Good evening, and welcome to our market coverage. Let's start with the closing numbers from yesterday. The Nasdaq finished at 25,476, down 0.43%. The S&P 500 slipped to 7,358, a loss of just 0.1%. The Dow Jones, however, managed a gain of 0.35%, closing at 51,848. The VIX, our fear gauge, dropped more than 4% to 18.63, suggesting some calm is returning to the market. The 10-year Treasury yield fell to 4.4%. The dollar index edged up to 101.58. The offshore yuan held steady near 6.81. Bitcoin fell 2.7% to $60,874. In commodities, crude oil tumbled nearly 4%, and spot gold shed 1.7%, closing at $4,014 an ounce. Looking at the broader picture, yesterday was all about structural divergence. Equity futures were pointing higher before the open, but that optimism didn't translate into sustained buying. The Nasdaq and S&P ended slightly lower, while the Dow barely managed to stay in the green. This tells us that while the market is trying to stabilize after the Federal Reserve's hawkish shock earlier this week, confidence remains fragile. Money is clearly rotating out of risk assets and into defensive plays. The 10-year Treasury yield falling for a second straight day is a strong signal of safe haven demand. At the same time, the broad sell-off in cryptocurrencies and commodities shows that risk appetite has not yet recovered. Let us walk through the session step by step. In Asia, Hong Kong and mainland Chinese stocks were under pressure, weighed down by the overnight decline on Wall Street and a stronger dollar. Europe followed a similar cautious tone. Then came the U.S. session. Futures were up 0.5% to 0.7% before the bell, but those gains faded quickly after the open. Defensive sectors like utilities and healthcare were the clear winners. On the losing side, crypto-related stocks, along with crude oil and gold, dragged the market down. Looking back at our morning note, we got the direction right, but we significantly overestimated the magnitude of the decline. We had expected a sharp sell-off, but the market only saw a narrow pullback. The biggest surprise was that the market had already priced in much of the hawkish Fed news during the overnight futures session. The VIX dropped from above 20 to 18.63, indicating that fear faded faster than we anticipated. Interestingly, investors seemed to ignore the deflationary signals from crude oil falling more than 4% and gold dropping 1.7%. Instead, they chose to buy treasuries. This suggests the market is more focused on the shift in liquidity conditions than on recession risks. Now let us look at the three-way interaction between the dollar, the yuan, and treasury yields. The dollar edged up, the offshore yuan weakened slightly, but the moves were very small. There is no sign of extreme capital flight, and pressure on Asian currencies remains manageable. The modest decline in U.S. equities also means limited spillover to Chinese stocks. The 10-year yield dropped from 4.49% to 4.4%, confirming a downward trend. A stable currency, stronger bonds, and a slightly weaker stock market. This is a classic mild risk-off combination, not a panic sell-off. For Asian markets tomorrow, if Treasury yields continue to fall, Hong Kong tech stocks could see a bounce. On the fund flow front, defensive assets remain the strongest trade. Treasuries and utilities continue to attract inflows. Crypto-related assets are the weakest link. Bitcoin has now fallen more than 5% over the past 7 days, and related ETFs are still under heavy selling pressure. This defensive rotation has been in place for 2 days now, and it qualifies as a short-term theme. Whether it persists will depend on upcoming economic data. Let us turn to the outlook for tomorrow. We expect the S&P 500 to trade in a choppy, slightly weak manner. The 10-year yield could fall further, possibly below 4.35%. The dollar-yuan pair is likely to stay in a tight range between 6.80 and 6.83. Bitcoin may attempt a technical bounce after being oversold, but there is no clear catalyst for a sustained recovery. Defensive sectors should continue to outperform. Overall, our strategy remains cautious. We recommend staying on the sidelines for now. If the S&P pulls back to its 200-day moving average while Treasury yields keep declining, we might consider a small position in tech leaders like Nvidia or the QQQ. But if the VIX jumps back above 20 or crude oil breaks below $68, we would abandon that plan. Our probability assessment for tomorrow is 30% for an up day, 45% for a sideways day, and 25% for a down day. The market is slowly emerging from the panic, but the real direction will only become clear with more data in the days ahead.